Oops, let me put one more person in. This is Alex Ferber from Green Egg Ventures. Oops, here they, I told you, they always come a few minutes late and hate to miss anybody. So Alex, I don't know if you want to talk about yourself and the fund and your background first, or if you would like everybody to introduce themselves first. It's up to you.
Sure, I'd be happy to jump into my background.
Okay.
Originally from Michigan, which is where I'm at now, visiting family. I grew up. I was very, very lucky. My father started a company and a CPG company, and I was able to sort of sit in all the different departments of it. You know, working in the warehouse, working in the logistics department, procurement, marketing, sales. Really was able to see all the functions of a business that make it work together. After college, I graduated in 2012. I moved to New York, and I wanted to work at a startup. I got very, very lucky. I ended up interviewing in a venture fund to work at one of their portfolio companies, and the fund ended up hiring me. I did not ever envision getting into venture capital, but I knew that once I was offered the opportunity that I had to sort of jump at it. The fund was called Metamorphic Ventures. I came on as an unpaid intern, worked my way into the processes to a point where I was too expensive to fire and became a full-time employee just a couple months after working there. Immediately, I fell in love with venture capital. Every day, just meeting people that are solving important problems. I felt, very, very lucky. Sort of like an imposter syndrome of why are these people sharing their ideas with me? I'm just, newly graduated out of college, and these people are very accomplished. But I knew that I wanted to be around that energy the rest of my life, be around those people and help them grow their businesses. So worked in Metamorphic for a few years, ended up leaving in 2015 and then launching Green Egg Ventures in 2016. We had our first fund, made 20 investments. It was a smaller fund. And then did well enough with that fund where we were able to launch our second fund about a year ago, right before the pandemic, which has been interesting. And we've made 12 investments out of the second fund so far. We invest in any software startups that are solving problems for businesses. So we don't do anything consumer and we don't do anything hardware. And we invest at a super, super early stage, like $6 million valuation or less. Provide hands-on support to the companies that we invest in. And then ideally we'll reinvest in that same company with a larger check at a later stage.
So typically, how large are your first checks?
Typically, they're between 100 and 200,000. And then the follow-on check is typically 250,000 to $1 million.
Okay. So.
And we're proud investors in Cattle Space.
I knew that you're investors in Cattle Space. So how large is the fund? Fund 2?
So the second fund we're still fundraising. It'll be between like 15 and 20 million by the end of it.
Okay. So should we have everybody introduce themselves and then we open it up to Q&A? So,
perfect.
Jason, you're muted, but you're my my first person up here.
I'll be your weatherman. All right. So, hello, my name is Jason Velasco. I am a entrepreneur and a business owner related to, we do primarily professional services around legal technology, data privacy, financial services model, specifically in the legal technology space. Our organization has grown pretty dramatically, and we've had a pretty robust, almost $2 million professional services organization that we've got mapped out. But we've also kind of turned into a technology bit of an incubator. So based on our professional services and working with clients, we've been able to actually develop early stage technologies. One, as I mentioned before, is a vaccine management system that is currently being deployed and that we're trying to ramp up to facilitate getting 5 to 10 million shots in arms in the next, by the end of the year. Another one is a M365 legal technology workflow engine, and another one is a strategic presentation website type of technology. So it's been interesting because we're morphing from just being truly a professional services organization to being a hybrid professional services organization that has a bent on building technology in the industry.
Oh, thank you. And we do try to keep the introduction short. Abby Sugar. Oh, are you muted?
I am now unmuted. Good morning, everybody. Great to be here. And Alex, I'm actually originally from Ann Arbor, Michigan. I also now live in New York City. So I have a
Nice.
special in my place in my heart for the U of M, and my parents still live there, actually. But my company, my startup is Play Out Apparel, and we are an e-commerce underwear and athleisure brand with no need for the binary of gender. So for anyone who doesn't conform to gender stereotypes, shopping for clothing can be super stressful. And why does it have to be that way? So we encourage people to shop by style and not by gender, especially because Gen Z, 56% of them shop outside of their assigned gender. We also specialize in limited edition prints. My co-founder is a painter. So in our athleisure and underwear, any items you see with prints, these are actually paintings that are then digitized and put on the fabric. And we've seen awesome traction in the past year. Society in terms of acceptance, in terms of like LGBTQ rights, in terms of everyone being able to express themselves authentically, is finally sort of waking up and accepting everybody. So we're raising a pre-seed round right now and really excited to just meet a lot of really cool people.
Oh, thank you. Adrian Stern.
Here we go. Can you guys hear me?
Yes.
Awesome. Yes, my name is Adrian. I'm the co-founder and CEO of Reveal. We're building the business OS for content creators. So when creating content, creators collaborate most of the time, and there are a lot of administrative and business tasks that need to be done properly for everyone to be credited and to have ownership of the copyright, get paid properly, et cetera, et cetera. So we're building a platform to automate that. Currently running pilots in the music space, because that's where I come from. So with indie record labels and some Grammy-nominated producers and songwriters. And what we found so far is that we save them over 6 hours of admin work for every single song that they create. And we are getting ready to raise a pre-seed round.
Oh, thank you. Carolyn Mccaffrey.
Hello. Thanks for having me again, Bonnie. So my name is Caroline McCaffrey. Actually professionally, I'm a data privacy attorney turned founder. I'm the CEO and co-founder of ClearOps. We're a privacy and security assessment and vendor management business, B2B SaaS.
Oh my God, Shand, welcome back.
Hey, Bonnie, how are you?
My neighbor when I'm in New York.
That's right. Yeah, I'm the co-founder of a company called Edgeworth. We are a platform that sits as a layer in the procurement technology stack. So you can think of us as a Bloomberg terminal for procurement, or maybe potentially a dark pool of liquidity, or a CME like futures exchange that augments the incumbent approach to acquisition of goods and services with tools for capital markets.
Oh, thank you. And thank you for keeping it short. Shavi. I think I pronounced your name properly that time, right?
Yes, that's correct, Bonnie. Thank you. Good to see you again. Thanks for joining, Alex, and thanks everyone for joining as well. Hi, my name is Shavi. I'm the co-founder of Vivo. It's an AI-based SaaS platform that helps businesses have a direct channel of communication with their customers. So we allow businesses to effectively handle customer engagement through engagement on social media, email, chat, with minimal human involvement. And we are currently raising our pre-seed round.
Oh, thank you. Chris Majoldo, since we have a few Chris's in here.
Thanks, Bonnie. Nice meeting everyone. My name is Chris Majoldo. I'm the Director of Operations at the Black River Innovation Campus in Springfield, Vermont. We are leveraging Springfield's 10 gigabit internet to essentially grow the digital economy of this region through startup incubation and workforce development.
Thank you. Give my best to Trevor.
Will do.
Christopher Haskell.
Morning, y'all, down here in good old sunny Miami, taking in-person meetings again, which is fantastic. My background is in CPG, and in the last 6-7 years on the tech side in supply chain AI, now doing advising and investing with startups.
Oh, okay. Janu.
Hi, can you guys hear me?
Yes.
Yeah, I work mainly in data science and AI for finance, and actually working for data science for venture capital. at the moment. Thank you.
Oh, no, we'll do Gemma next. Gina or Gemma? Nope. I guess, Lior, why don't you introduce yourself?
Hi everyone. I'm Lior. I'm actually talking out of Israel. Glad to be here. I spent 12 years in New York, so that's how I know Bonnie. And thanks again for inviting me. I'm really glad to be here. That's my first time. I'm the CEO and CTO of Cognility. We are building immersive product guides using what we call video assistants. We are an AI company, which our clients are consumer product manufacturers. We have already raised our pre-seed and actually we are still in the round. That's it, my first time. So so far so very interesting. Thank you.
Trip, why don't you introduce yourself?
My name's Trip Braden. I do a lot of work in private equity and in a lot of strategic acquisitions. I've done 70 strategic acquisitions. Typically what happens is a client will come to me and ask me for a particular kind of capability. I'll go out and find it for them. I've done 70 of those in my career. I've spent a lot of my clients' money over the years. And the other thing that makes me a little bit different is I help the teams I work with specifically to become more high performing. So a lot of the work I'm involved in today in early stage companies is really helping them get the right people in place and make sure they have the right structures to scale.
Oh, thank you. Joseph Katz.
Morning, everyone. I'm in northern New Jersey. I head up marketing for Kettle Space. I've been a marketer for startups for the last dozen plus years. So if anyone has questions about growing or building, feel free to reach out to me.
Oh, thank you. Kyle, welcome back.
Thanks, Bonnie. Calling in from Colorado this time. So
no Pittsburgh this time.
Not Pittsburgh, but yeah, I'm for the last 5 years or so, I've been making early stage investments through a family office fund based in Pittsburgh. Had been living in New York until the tail end of the lockdown there. So the Northeast is my main network in that space, and similar size checks as what Alex mentioned as well.
Oh, thank you. Mahul, welcome. Where's Mahul?
Hi, good morning. I'm the founder of Diamond Hedge. It's the first augmented reality diamond price comparison company. We recently got a patent on it, and we have around $5 billion worth of diamonds on our platform. So keep it short.
Wow. Michael Adler, again, welcome back.
Thank you, Bonnie. Michael Adler, calling in from Philadelphia area. I help turn people's side hustles into their main hustles as their business and real estate attorney. I'm also an entrepreneur and investor myself. So I help people turn from their startup to acquisition, to introductions with venture and angels and exits, also partnership fights and business divorces. I also work with a lot of nonprofits, and I'm also very active in the creative economy, especially in the greater Philadelphia area, but artists, athletes, sculptors, painters, musicians on sort of the business of their art. Thanks as always for having me. Great to see you.
I'm going to ask the angels and family offices what they invest in as well, but didn't want to take away from our guest today. Sam.
Coming off mute. Hi, it's Sam. I'm CEO of Axle AI. We're a 23-person, largely bootstrapped software company with a platform for media teams, about $1 million run rate, and starting to do more equity crowdfunding at this point. Anyway, love to hear what folks have to say today.
Oh, thank you. Scott Purdy.
Good morning. I'm Scott Purdy, company Sine, based out of Philadelphia. I'm calling from South Jersey. In another career, I spent quite a bit of time in Ypsilanti. So I know that area up there is really beautiful. But what Sine does is we're a software startup that is developing we've developed a tool that is crowdsources video input from different people and creates a finished product in a very short amount of time, and actually a professional product. Quick example would be a lot of people taking different videos at a wedding, goes into one place and it makes a completed professional video in a very short amount of time. The producer of it gets to pick the things, and we're ready to start looking for a good investment now to get the AI that's needed to be able to do the little things like pick out of someone with red hair or a wedding cake or something out of the video. So we're at that stage now. Our product has been used by Magnet Magazine. They have a thing called Magnet Television. They've been using it for about a year to interview different people in the music industry around the world. And I appreciate coming. I've become kind of a regular here. So, and I really enjoy listening. And Alex, thanks. I really appreciate the time that you and the others have put in to give us the information.
Thank you. Bobby. Bobby from ClearOps? Oh, that's Carolyn from, so let's hear from Carolyn from ClearOps.
I already went.
Oh, you did? Okay, Catherine, welcome.
Good morning. Hi, I'm Catherine. I'm with Legendary Venture Capital. We're a $100 million fund headquartered in New York City, Anaheim here in Los Angeles, and we have a Silicon Valley office. We are more of a private equity shop with a VC arm. We invest domestically and internationally. We're in Fund 2. Check sizes can be 50,000 to 5 million. Is average is 250 to 5, but we can go even larger. Our biggest participation in funding was SpaceX. We also lead, co-lead. We just go by deal. So happy to be here.
Thank you. So Bobby, are you, do you want to present or should we go to the Q&A? Oh, you're muted. Or maybe she has bad connectivity too. So questions? Any questions for Alex? There are always questions.
I just, yeah, Alex, when you're typically looking to invest in somebody, what are, especially if it's someone, like us who does, we've been self-funded so far, really not projecting any revenue at this point in time. We're just trying to get, people using the app out there. So what would you look for in like a company like ours, like a team or specific financials?
Yeah, it's a great question. Every fund has a different strategy. For us, we would definitely need to see some revenue from customers just to assess the product market fit. But of course, on that note, the team still always comes first. For us, one of the most important questions, if not the most important question, is why are you starting this company? We want to invest in people that have suffered the problem that they're out to solve, that they're really on a mission. More so than the person that just graduated from Stanford, engineering school. So understanding why you're solving it, why you're the right person to solve it, is a huge part of it. And if you can answer that, then that checks a lot of the boxes.
Okay. To back up on that, what if we were to say that we believe we are first to market with this product? While there are some competitors, they're not taking it to the level we think. And you probably do hear that a lot from people. So I was just curious on what your take on that would be.
Yeah, you're right. We definitely do hear that a lot. And of course, there's times it's difficult to argue it at times because a lot of it can be subjective. I think it goes back to that rule of, if you're in a space with other competitors, are you 10 times better? Are you, shoulders out of the water better where it's not arguable? And I think that is what needs to be proven, if someone wants to get attention. If you are, first to market, I'm not sure how, obviously I'm not very familiar with your space and the competitors that are in it without doing diligence. But, if someone's first to market, obviously and they are truly first to market without any comparables, it's a different story.
Thank you. Next question.
Yeah, can I hop in?
Sure.
I'm just curious, Alex, to what are the trends that get you most excited? What are you looking at that you're eager to get into?
Yeah, that's a great question. And it's one I get a lot. Obviously right now with the pandemic, there's obvious answers that, I don't want to waste too much time with, but, digital health, future of work, which is why we're so excited about Kettle Space, for example. But to be honest, I really try not to have any preconceived notions of where we should be investing and what the next hot space is, because whenever I do, I'll meet a founder that's solving a problem I never knew existed, and I'll just get, completely swept off my feet and, dive into a whole new space. So, for me, I try to just take things, a day at a time, and really try to see everything with a new clear lens. I often see investors that, they'll have a certain thesis and they'll make an excuse for investing in a company to match the way that they see the world. So I try not to, I try to read as much as possible and see where the world's going, but I try not to have any preconceived notions about where I think it's going.
Thank you.
So to follow up on that, do you think a thesis can be misleading to some extent for investors?
A thesis, well, I think that it's important to be an expert in some areas. Like if someone came to me and they're like, hey, I'm developing this product to sell through Instagram to consumers, I'm just uncomfortable investing in that. I don't have experience in that. What I do have an experience in is assessing, speaking to customers that are paying to use a B2B product, hearing the emotion in their voice of what their life was like before they used it, what their life was like after using it, and assess product market fit. So, I think that maybe your question's more directed towards investors that are focused on like AI or health tech. And I think that, all those verticals are so broad that within health tech, within fintech, there's so many different directions that you can go. So I think that you can have that mentality of being open towards everything and still be vertically focused. And, I don't pretend that I have, that's what works for me, right? And what works for another fund might work for them. So just because that's the way I do it doesn't mean that I think it's the best way to go about it.
I'll pop in with a follow-up question on that. As you're talking about, I mean, sometimes evaluating things like what markets you're familiar with or how you look at things can be so subjective. And do you find, I was asking another VC scout and angel investor this question, and I would love your opinion on, if someone approaches you to pitch, are you first and foremost evaluating it from the approach of your VC fund as a VC? Do you do any angel investing, and how does your brain sort of separate the two? And do you have a different thesis for that, since angel investing is so personal?
Yeah, it's a good question. And, I'm still very early in my venture career. We're on our second fund, and, it's important that anyone that's investing in Green Egg knows that my attention is 100% on our investors in the fund and on those portfolio companies. And there's never like a chance that, I would invest in a company because I want to have my own personal money in it. Because obviously there's a lot more to gain if I'm angel investing in a company and it becomes big than if the fund does and I make carry on it. So, maybe I'll get to a point in my life where, I do love to see consumer deals still, right? Things that affect my life personally. And maybe, that's enough of a difference where Green Egg Ventures is big enough and consumers different enough from B2B where I can do those types of things. But at this point in my career, I prefer to keep things just very organized and focused on what the fund is looking at. But that being said, and as it relates to you, and this is another topic that we can explore, but one of the most important functions of a fund is their ability to get good deals and source deals. And a part of that comes from sending deals or being a productive part of a network. And that means that when we see consumer or fashion or other types of investments, that we can pass them on to investors that we know in that space. So, just because I focus B2B doesn't mean that I'm tunnel visioned on just that. And I try to be a valuable part of the venture community. So it isn't a waste of time for someone to ever just reach out, is what I'm saying.
May I have a follow-up, actually, since you were talking about your personal beliefs, but I want to ask regarding the business case for such an early stage fund. Isn't that, because I always thought it's a very risky time to invest in companies, there's not yet a lot of indicators whether it would be successful or not. could you talk a little bit about that? I mean, how do you gauge the risk and how do you avoid it?
Yeah, I mean, it's a great question, and there's a lot that could be explored there. But what I'll say is, you know, there's a trade-off with everything, right? If I'm investing later in a company, then I need more to be successful, or I need to invest more money into them for my fund to be successful. Whereas at the early stage, when I'm investing in a company that's valued at $5 million, if they get acquired for 250 million, like that, which is much more, which happens, you know, orders of magnitude more often than a company IPOs for, you know, $5 billion. Like that's a home run for me. So, so sure, I might have, you know, more companies that go out of business in a Series A fund or Series B fund where there's more indicators, but I need a lot less of them to hit, and I need less capital to do it. And where I've become an expert is mitigating risk. That's pretty much my job, is trying to, you know, find where risk is in a company and mitigate it. And you know, I think there's a longer conversation within, you know, the strategy of our fund and in the ways that we do that. But what's very fortunate about early stage investing, and these are all, you know, validated numbers, but funds that are, you know, like 50 million or less, or, you know, 100 million or less, perform really, really well typically in comparison to later stage funds on average. Of course, you have a higher chance of completely missing the target, but the returns are better. So we're playing a game where we're like the casino, you know, we're like the casino. If we just invest, if we do everything that mitigates risk, then the odds are in our favor to be successful in the long run. The difficulty is, do you have 7 years, you know, to wait until your first liquidity event, which is something to consider when you're investing early stage. If you're investing Series A, Series B, your company might get acquired in 2-3 years because the company is further along. So we're playing a winning game, but there's other difficult factors such as the risk involved and the liquidity, lack of liquidity.
I see. Thank you. That's very interesting. And actually, a follow-up on that would be, what kind of, if you can say, I mean, at least the range of percentage that funds like yours are taking, I mean, in terms of shares of the company.
Yeah, you know, typically for us, you know, if we're putting $200,000 into a $5 million company, you know, was that my math isn't as good since I graduated college, but I think you got it.
Yeah.
And our goal, though, and on that note, you know, one other thing is that we like to invest creatively, and what I mean by that is, you know, we're very close with our portfolio companies and our founders, as I'm sure, you know, Space can tell you. And, you know, what we like to do at times is reinvest, maybe not even at the Series A or Series B, just we have a great relationship and we'll say like, hey, you know, what, you have 8 months of runway. Why not take an investment from us, get to 12 months, have peace of mind that you have that longer runway. You can reach the metrics that you want, get a better valuation at the next stage. So, you know, when we're making that first check, it's really like getting our foot in the door, you know, building a relationship with that founder. And, you know, Space is a company that we've reinvested in. And then to reinvest, you know, at times that not necessarily are the Series A, but at times where we can actually get more equity in the company. But we feel better about that because we've already been working with them for a year or so.
Okay. Thank you.
As a Kettle Space representative, I'll just echo what Alex said. It's more than just the money that he puts into the business. He's putting his time, his resources. It's strategic help. So it's a lot more than just the money. I think my experience with startups, you know, money is important, but it's the strategic help that an investor could provide that's going to really help you get to that next stage.
Very important.
Yeah, I wanted to follow up on that. Alex, what do you feel are the best ways that you guys help the startups that you invest in?
Yeah, great question. I think the first and most important thing is that sometimes startups don't want your help, which you know, I think the important thing coming to a company is saying, in which we say is like, we're here when you need us, and we're not going to bother you for monthly KPI, you know, monthly updates and things when your head's down. So Each company is different and has different needs. And, we're not professionals in marketing, we're not professionals in hiring, but we're like, when we're investing in a company of 2 to 4 people, we can sort of be like the Swiss Army knife, right? You're worried about all the things that can kill your company. We're going to help you with some of the projects and things that won't kill your company, but there are things that you can't get to because you're worried about the things that can kill your company, such as getting funding. So where do we help the most? Where do companies need the most help typically? Fundraising is number one. Typically we'll come in, invest in a company. Once we decide to invest, we don't wait for a lead, even though our check isn't a lead size. We'll typically invest, put money in, and then help them find the lead investor or fill up the round with other micro VCs. So a huge thing that we do and try to be helpful with is fundraising. Second is hiring is a big one. And then thirdly, as Joseph kindly brought up, and we've been helping Kettlespace with, is more like lead generation. Understanding a pandemic hit, our customer segment that we're targeting has changed a little bit. How can we most effectively go after the right people, and we'll help with that as well. And there's other smaller things, whether it's like which I was working with Nick on, just the helping make sure that everything looks good with the deck, or talking through pitches and hearing pitches and giving an investor lens on it. So sort of those like strategizing meetings, brainstorming meetings. So I'd say, yeah, those are the areas that we provide the most support.
Alex, can I jump in here?
Of course.
I'm curious to hear kind of your opinion more broadly on what's happening in venture, and maybe because we write similar sized checks. From my perspective, it's kind of baffling what happens in the later stages of the venture fundraising path. And to some extent, I think it's a risk for early stage investors that exists in almost any investment, that there's going to be some company that is able to raise 50 million right off the bat, and then within a year they're this behemoth. And how does a company compete in that landscape?
Yeah, so I just want to make sure that I understand correctly. So you're basically saying, like, if you invest in a company and then Andreessen comes in and puts $50 million into a competitor because they see that other company's doing well. Yeah, I guess that I haven't really experienced that too much to be honest. I think oftentimes, and maybe this goes back to the team, but sorry, that was I guess just that Michigan brain reference came in. But you have to invest in a team that makes it more it's worth the while of that investor to invest in the founding team because they're so good, than it is to go off and try to do it themselves with the new team, right? If you invest in the right people, and it's more expensive for a fund at that point to try to compete with a great team than it is to fund it themselves. So, of course, at the forefront of any investment that we're doing of our mind is, what are the risks of investing in this company? And at the top of that list is always competitive risk, whether it's existing legacy players or new entrants, nimble, startups. So yeah, I guess, like I said, I haven't had that experience yet where I've seen that, but I think it just comes down to investing in the best people, and then being able to feel good about it because you've invested in the best people.
Yeah, I totally agree. Yeah, I think it's interesting, just the lean startup mentality seems to not exist in the later stage, but with the pandemic and everything, to me it's reaffirmed that teams that are able to run lean are the most resilient teams, and
yeah,
they prove that they're actually dedicated to the mission in those times.
Totally, I totally agree, and it goes back. I think that when you're investing in a team that's mission driven, not just into to get rich, but really into solve a problem, they're more resilient when something like a pandemic hits. I guess like, you know, maybe like those mega rounds of $40 million seeds or Series A, like ridiculous. You know, I think that they can be sort of, I think they're outliers in a lot of ways. You know, they make the news headlines, but you know, there's millions more companies that aren't able to do that or reach that. So as an investor for me, and I guess this is a little bit on a different topic, but like if someone's able to get far, you know, without spending a lot of money, like that's a great sign for me as an investor, because I know they can do a ton with my money. I see too many companies that are like I have an idea, so I'm going to go out and raise 250,000 from friends and family and build it and then launch it. I think there's a lot of creative ways for companies to get to an MVP and prove product market fit without spending money. And as an investor, I get really impressed when I see that happen, and I think it helps them raise from, you know, other investors like myself when they're able to do that.
Thank you.
Thank you. Oops. Next question.
Hey, Alex, quick question for you about how you and the rest of the partners at the fund distribute work with companies. So do you guys focus on different verticals within B2B space, or are you all of you completely industry agnostic and you work with any kind of companies that's in the B2B software space, depending upon who ends up working with or playing with one of the partners at the firm?
So it was a little quiet at the beginning of the question. Do you mind just repeating the first part?
Yeah, sure. So my question is how you and the rest of the partners at the fund distribute companies that you guys work with. So do you focus on certain verticals within B2B SaaS?
Gotcha. Yeah, that's a good question. Honestly, we're all very general within B2B, so we don't separate, you know, between. There are definitely, like, for example, Stefan on our team comes from you know, his family and his background in a like medical space, the healthcare space, and the fintech space. So like if we see those kinds of deals, you know, he'll usually take the lead on that, whereas Jared is more in like the marketing and advertising space. But typically our process is where you know, if a deal comes through to me, Jared, or Stefan, we'll meet with that company if it makes sense. And then if we like it, we'll bring the rest of the team in to meet together. And then from there, we sort of dive into our diligence, which is I guess another topic. But I would say that we're all pretty general, given how, you know, small and early our fund is.
A quick question. If you're looking at a company who has not had anybody invest in it before, they've been self-funding, do you always, and you're interested, so you definitely want to invest in them, do you always go to a seed round, or have you ever bypassed that, just gone to like an A round of investment, a larger amount?
Yeah, you know, the whole A, C, B is kind of silly because it's just like, you know, it's labeling rounds that, you know, there might be 3 rounds before the seed and 12 rounds between bridges. So, you know, I guess to answer, you know, it's more about what this company needs to be successful over like the next 12 to 18 months and what amount of money do they need. Now we, you know, as we're very strict, you know, we're doing up to 200K in the first round no matter what, because the second that we you know, it's sort of like the hundreds. It's easier to be 100-0 than 99-1, right? If we make exceptions once, like when do we make exceptions? It's something that we have to consider every time. Whereas, you know, our strategy is we minimize risk in the first check, work with that company for 12 to 18 months, and then if we feel comfortable taking a larger check size. And you can't know from meeting a company for 3 weeks to 2 months, you know, whatever that investment, that diligence period is, you can't truly know from our perspective what they're going to be like over the next 12 to 18 months, right? So for us, it's very important to minimize that risk early on by doing a smaller check before we invest a larger. So for us, the answer is no, we wouldn't just jump right into a larger check off the bat, but maybe other funds have that strategy. Like I said, our strategy isn't the right strategy. It's just the one that we sold to our investors in our fund, and it's one that we therefore are sticking with because that's what we know and are good at.
Great, thank you.
Yeah.
Next.
I actually have a question, maybe for both Alex and Kyle. What do you guys think about equity crowdfunding? We've participated. We had one last year. It went very well. We're going to do another one this year. But in traditional VC circles, it's considered to be like, oh, that's weird. You know, why are you doing that? What are your guys' opinions on equity crowdfunding, and maybe even if you've looked at them, the different companies like, you know, Republic or Start Engine?
Kyle, do you want to go first, or do you want me to go first?
I don't know that I have much commentary on it. Actually, I've looked into a couple of them. Seed Invest, I think in New York at the time, was one I'd spent some time with, but I've never had a portfolio company go to crowdfunding after a check. Our goal is more so to get them to an institutional round, because I think it makes a big difference when you have a brand name attached to a company of a VC. It lowers the risk, I think, substantially in our eyes.
Yeah, I honestly, I have pretty much the exact same feedback as Kyle. You know, I guess I don't have really strong opinions about it so much. I've never invested. We haven't invested in a company that has gone that route, but we haven't not invested in a company because they have gone that route. I think, and it goes back to, you know, the value that investors can add to a company. I think that you know, getting an investment from, you know, like a brand name fund or a fund that is adding strategic value helps to go a long way for a company, whether, especially within the B2B space, where a lot of these early companies are really just need introductions to potential customers, or just to feel out product market fit, to talk to customers. I think that funds that are experts in those areas can be super, super helpful. So, you know, I wouldn't not invest in a company that raised equity crowdfunding. I guess I don't really have any really too strong of opinions about it.
So Kyle, since you've been brought into the investor side of the conversation, I do want to ask what your focus is, what the fund's focus is.
Yeah, it is generalist. So we've invested across a number of verticals, including robotics, SaaS, medical device. But software companies are the largest portion of that, probably 50%. And then opportunistically through our network have invested in early stage spaces we're less familiar with, like medical devices. But it's always interesting learning something new. So that's why I don't turn down many meetings just based on industry.
Consumer at all? Just curious.
I've looked at only a couple, to be honest. Yeah.
Okay, thank you. So next question.
Actually, as a quick follow-up to Kyle. Kyle, I think one of the, you said you take lots of meetings. I mean, how much time do you spend actually just kind of, you know, spending, you know, the 15-30 minutes to just get a feel for somebody, and what are the things that you're looking for in those conversations?
Yeah, I guess you're right. I could take more meetings. It's not the largest portion of my time. I'm spending a lot more time reading and doing research, but yeah, it's typically companies that get recommended through a network that I'm taking meetings with, not a whole lot of blind meetings, but yeah, we try to verify through our network and then incubators as well, just so that, you know, the limited resource of time isn't kind of wasted as well.
Thank you. Alex, do you have any, what's your insight? I mean, you know, sounds like you spend quite a bit of time working with your folks as well.
Sorry, do you mind repeating the question one more time?
So the question was, you know, in your busy schedule, how much time are you actually spending kind of taking those, you know, 15 to 30-minute calls just to validate, and what are you expecting out of those initial conversations?
To validate the companies that we're investing in?
Yeah. So say, you know, okay, you got introduced to you know, to Chavi, and now you want to, you know, you want to at least give him that first kind of initial phone call.
Oh, you know. Gotcha. Gotcha. Yeah. If a company meets our thesis and we're interested in it, we meet with them. First off, we respond to every company that reaches out cold, and we explain if it's not a fit, why it's not a fit, and like 90% or 95% just aren't a fit. They're not a B2B. They're not a B2B company within the 6 million or less range. We have extended it out to like $7 or $8 million valuations, but so that's a screen. And then there's other factors, like such as sometimes we'll see like 12 of the same company in a space, and it's just difficult. Even if one of them is truly better, it's very difficult for us to do diligence and to assess like the intricacies of which one is going to win and make a judgment. So if something matches our thesis and it's interesting, we'll meet with them every time. And I always encourage other investors to send me deals that might not even be a fit for us, but because I think, and to answer maybe your question a little better, is I just like to see everything that's out there. But it's more efficient to do that through just like reviewing decks than to take a bunch of calls in the day. If that answers your question.
No, that's great. Thank you so much. That's very helpful.
And that's why I always tell entrepreneurs, keep your decks concise and to the point and tell a good story. Jake,
yes.
You're a latecomer. Yes, you have to get them because they're looking at a lot of decks. Jake, you're a latecomer. Would you like to introduce yourself? You're muted at the moment. Jake? I guess not. So questions?
Yeah, can I follow up on the deck question or point?
Sure.
Because I'm working on our pitch deck right now. What are the big no-nos for you, Alex? What are things that like you see in the deck and you're like, okay.
Yeah, great question. Okay, firstly, this happens, and everyone's probably heard this a million times, but it needs to be reiterated. We don't need to know every single feature of the product and everything going on. It's what problem are you solving? How are you solving it? Why are you the right person to solve it? And what's the gain? How big is the market? What is the gain from solving it? Just to like paint a picture for you. And every fund has their own process. For us, we meet once or twice a week to go through all the deals that were sent to us, and we're going through like 30, 40 decks in this meeting, right? And so your deck is up against all these decks, and it just, if there's 35 slides in it, and you're, the 12th deck that we're reviewing, it's difficult to like really fall in love with something and to really give attention to it. So keep it very short and concise. Answer those questions. What problem are you solving? How are you solving it? Who are you the right people to solve it? What's the gain from solving it? I'm sure there's other, smaller things. I mean, there's other things like, defensibility, but those are like the main things. Other mistakes, aside from to reiterate, it being too long and too full of information, a lot. That's really the main one. Like if I'm just looking at a deck off the bat, the other thing is like, if we're doing diligence on a company, if we got to the point where we're meeting with them and speaking to them, if there's clearly a company missing from your, competitive landscape or something, like a glaring competitor, like that's a red flag. Try to get other deck mistakes, but yeah, I would just keep it to that. Just keep it concise. Answer those questions.
As somebody who mentors at accelerators, do you not focus on revenue model and go-to-market strategy?
No, those are important. I guess go-to-market and revenue are both important. The issue with that is like companies change. The best companies change very rapidly based off product market fit, and like product market fit is a moving target. It's like working out. You don't just get in good shape and that's it. You have to work at it every single day. And when you're talking about like go-to-market strategy and product and revenue model, it's good to have an idea of like where you want to go. But I think it's more important to understand that what you what that looks like now is not what it will look like when you've actually achieved product market fit. So I think it's important to have reasons for why you feel that way, but I think that's less important for sure than the other questions. That's just my opinion, though.
Okay. So another question, which I noticed that not a lot of founders have, is that yes, they will work on their pitch deck, but they don't necessarily have an executive summary. Would you look at a company based on an executive summary first, which is just a one-pager shortened to the point?
Yeah, that's a great question, and I'm sure other investors will have opinions on this. I really don't have a strong opinion on a one-pager versus a deck. For me, how do I pull? And I think it's also helpful when a company reaches out or is introduced. There's like a little blurb about it, like a paragraph. But for me, what's the most digestible way to present your information? And sometimes it's a one-pager, right? Obviously, there's less slides, but it's more wordy, or a slide deck where you can sort of take someone through a story. I guess I would prefer maybe a deck on that note, because at the end of the day, you are selling a story, and I think that just it's easier on the eyes to go through slides that are sort of guiding you down the path versus like looking at a bunch of words on a page and trying to figure out putting the pieces together. But we will take meeting. I would say I don't have a strong preference.
Okay, thank you.
And Alex, quick follow up on that. In terms of, is there a particular style of deck? So I've been playing around with like the Guy Kawasaki, and then the Musk version, which is much more visual and more exciting. And then you have the traditional one, which is more than 15 to 20 pages. And I see Adrian smiling because you're working on your pitch decks as well. Is there one that kind of stands out to you as kind of, what's the right blocking and tackling to get your appetite whetted?
Yeah, well, I would say the first thing, and I'm sure people are going to disagree with me a lot, but I really like to I'd like to be able to download a deck and have a deck. Like, and there's a lot of reasons for that. As we're sharing investments with other startups, it's just a lot easier to be able to share like downloadable decks. And so I like DocSend a lot, and I like just having like a downloadable version personally. I don't want to lead anyone down like a certain format's better than another format. I don't really have a strong opinion. If you're answering those questions that I brought up in a way that's concise and organized, that's the most important thing. I don't think it's really important to focus on like the style. Just don't keep it not wordy. Answer those questions, and I wouldn't worry too much about how you're doing the deck. But for me, like I said, personally, I like to be able to download something. We have a database that we use to organize all of our deals, and we lean on that database when we're sending deals to other funds. And it's just much easier to have that deck. And we want to help companies fundraise, so it helps us when we can download it to help you fundraise. But yeah, that's it.
As a follow-up to that, if you download a deck, the deck that we would do in a presentation would be much shorter than maybe the full deck that we would have that we would send to someone to download. So in that sense, would you prefer to get the shorter presentation deck or a full download deck that has much more information?
So that's interesting. Typically the first deck we'll get will be like the short one, and then the presentation deck will be longer because they're you're speaking to it, and there might be just like a slide with one word, and then this next slide's got like a thing under it. So I guess to answer your question, I think that the first thing that you reach out with should be the most concise and the smallest. If your presentation deck though is built in a way that it's not easy to follow because it's made for someone speaking, I wouldn't send that, of course. But the first deck should be like a teaser, much shorter, gets the information across that I mentioned. And then depending on how that meeting goes with that investor, if you feel comfortable with them and you're exploring further diligence, then you can have a follow-up deck that covers more of the details. And I think too, when people are presenting, it also comes back to being concise in your ideas and explaining what problem you're solving, what the solution is. And then, I love when the actual presentation is more concise and answers those questions. And then there's like a oh my God, I'm blanking out. At the end of the deck, there's a what's the word?
Appendix.
What people? Sorry.
Appendix.
Yeah,
Appendix?
appendix. Thank you. Yeah, exactly. There's an appendix where if I have a more in-depth question, that it's in that appendix. So it just shows that this person has thought about this question. So it's really about letting the investor sort of guide that conversation rather than trying to tell them things that you feel are important. Letting them ask the questions that are important to them, and keeping your presentation very broad, very not in depth, and letting the investor sort of guide the conversation, but being prepared with those appendix slides to go more in depth to where the investor wants to.
Thank you so much.
Next question.
I have one. This is Trip. I was wondering how you talk a lot about marketplace assessment, but it's not as important in early stages, obviously. But how do you look at that, and what patterns do you see that you'd like people to avoid? Because whenever I get one that tells me it has every business that's out there, and they really haven't picked a niche. They really haven't got a lot of deeper research. So how do you look at a marketplace assessment before you?
Do you mind defining marketplace assessment?
Sure. Typically, it's a landscape. So I'm going to look at where it plays in the market, what else joins the market potentially, because I'm doing strategic acquisition. So I'm going to look at things a little differently than you will. But one of the things I find is people tell me especially early stage companies, we can service everybody. But that shows that they haven't really done a lot of work on thinking where they want to be or where they think their uniquenesses will play strongest. So I'd like to hear what you've seen that works with how they do that.
Yeah, I mean, the product market fit is the number one reason why a company fails, and having too broad of a market fit of a product, having too broad of a customer segment is one of the reasons that product market fit isn't reached. I think a lot of it comes down to the founders, what their background is. Did they suffer the problem themselves? And if they did, then I think they have a good idea of the other people, and they have connections to the other people that suffer the same problem. So for us, I think it's very obvious to say that if someone's very broad in it, that we're going to have a problem with that. And we don't invest in companies until we speak to customers that are using it. So for us, nothing proves product market fit like having paying customers, right? Convincing someone to buy your product and then convincing them also to get on the phone with an investor is a good indication. And then in our conversations with companies that are using the product, a company can tell their customer to say nice things about me. We're this investor looking to invest in us, but you can't hide a product that someone loves, right? And if you're having 5 to 10 customer calls and people are not shutting up about it, they're talking about their life beforehand. It was so much more difficult. Now this product has, changed everything. I couldn't imagine it being taken away. And they're going on and on about it. Those are the companies that we invest in. So when we're looking at the market, at the market that the company's operating in, we're hoping that when we're having those customer calls that they're of a certain makeup, they're consistent, and the company's solving a consistent problem for them. And if we have enough conversations with customers that the company is solving a consistent problem for, and they're clearly excited about it, that indicates to us that they have found their product market fit, that niche. And then, of course, you have to look at the story in general, because oftentimes that beachhead market isn't enough to make this a massive, massive business. So it's about understanding how that beachhead market relates to where they want to go in the future. A great example of it is one of our first fund portfolio companies. They're doing unbelievably well, a company called Acrolus. They are a fintech company, and they help lenders lend more efficiently. They're a tool for lenders. When we did diligence on them, they were working with small accounting firms, divorce lawyers, and those are the folks that we called. And the plan was always to move from those smaller businesses to the large lenders of the world, the Ondex, massive direct-to-consumer lenders. So we were able to validate that their product was solving a problem for these smaller businesses, and then be able to see the bigger picture, the story of where this beachhead market can take them. there's a lot of reasons why beachhead market's important. Of course, firstly is to having traction and having money coming in is important because it gives you more runway. It gives you a license to go after different markets. So yeah, it's all about the beachhead market at first and having that focus.
That was great. Thank you.
Can I follow up on that point? Because what we're doing is we're helping musicians, deal with copyright, collect metadata for their songs before they distribute them, make sure that they're credited properly so that they can collect royalties and sign agreements with collaborators, et cetera, et cetera. And a lot of those tasks, could work in other content creation or media creation environments like film, even photography, and even non-digital media. Actually, you're still signing agreements, you're still paying each other, you still got to credit each other. So our beachhead market is obviously music, but we see a potential beyond music. My question for you is, like, how fully thought out does that possible expansion plan need to be when you're pitching, at a pre-seed stage?
Yeah, I mean, it's definitely, you definitely have to be careful because, again, your beachhead market is musicians and folks in the area. And I think you would find, again, I don't know for sure, but I think you'd find that if you got into other areas that there might be a company already doing it or focusing on that area. So your competitive advantage might be your focus on that area. Now, it's in I had a panel, I moderated a panel last week with Jerry from Laconia, who said it best, but not at the end of the day, investors are buying a story, right? They're investing in you because they think that this could become a massive business. So we won't invest in a company that doesn't have that beachhead market figured out, that has that product market fit. But we also, that's the first thing. We also won't get to an investment if we don't believe it can become a big business, if you can't sell that story. So I think it's important to have an idea of where you want to go. I think that from specific to you, to maybe have one or two areas that are most closely related to you, I think is more realistic to say off the bat than like whatever legal things in general and everything. But I think it is important to sell that story for sure.
Yeah, no, that makes a lot of sense. And actually, record labels that we're talking to are telling us that they want to use it for like their video clips and capturing the credits for video clips, et cetera. So yeah, I get your point.
It is important on that note.
The jazz sense too. Yeah.
For sure, yeah, exactly. On that point though, and I see this happen all the time. Someone will get their big customer, and this big customer will want this and this, and they'll start building custom solutions, and and you have to really be focused on your beachhead market. And it could be easy to want to do everything for that one customer, and it sometimes you should. I'm not saying that in every situation you can. I'm just saying you have to be careful because you don't want to turn into that. Into that. Once you hit your beachhead market, you're able to hire 25 engineers, and by all means, please. But until then, focus on what you do best.
Next question.
So I was, hi, Alex, wanted to ask you a question. You say that your initial investment is 100 to 200K, and you talked about the valuations that you prefer to see. I'm curious as to is that an equity round, or are you doing safes? You doing some sort of a convertible note? And then also, how big is the entire round? Like, how much is the company bringing in from other investors typically?
Yeah, that's a great question. And there are a lot of funds that will only invest in equity rounds, or they won't invest in safes. So I think it's always good to ask this question to an investor, before you get late in the process and find that that's going to be an issue. For us, we definitely have preferences, but we invest in. I would say our least preference is a safe. I would say out of our 12 investments of our second fund, most are safes. So I can say that, but for us, we're very we're flexible. It's more about the valuation. So we'll invest in notes, we'll invest in safes, we'll invest in equity rounds. I don't want to tell a company to do an equity round when they don't want to spend the legal cost of doing that, right? Once we invest in a company, we're in the same boat together. So we should be seeing eye to eye on what will make and what works best for the business. Because we're both in the same boat. Of course, we have to consider things like if a company's valued at 6 million and they're raising 5, right? That's an issue. They're diluting themselves hugely, and we're getting diluted, of course, is a major thing. And founder equity is a thing. It's important that everyone feels motivated, and they should feel motivated. I think everyone wants to look back 3 years down the line, 4 years down the line, and feel like they got a good deal, right? Those kinds of relationships, those compounding interest relationships, are what's important in venture in the long-term game. So, whatever the round is, it shouldn't be seen from the perspective of what's the best possible deal I can get. It should be, how does everyone feel good about this? Because you don't want to be 2-3 years down the line, and because you decided to, nickel and dime a founder, now they have 4% equity in the company, and they're unmotivated to make it work. So those are things that to be considered, but there's no hard and fast rules for us. It's sort of a situation by situation thing.
Next, speaking of safes, I was in a clubhouse room, actually with a friend of mine, and it was a very small room. And he's actually the investor who came up with the idea of safes. And he said when he originally had the idea, he meant it for like 20% of the very early stage, just to make it easier. He said, it's now 70%.
Yeah, and I think on that note, a lot of it has to do with the fact that in the early stages, there's a lot of capital, and out there, and I think that a lot of the best companies can command better terms, or a better, vehicle by which to invest on. And I think that a safe agreement is like the best thing in a lot of cases for a company, because it's it's cheap, right? Similar to a C note, but whereas a C note is debt, a safe isn't, right? So we've had companies get acquired from our first fund that because we held a convertible note in them, we got debt converts before equity, or debt liquidates before equity. So we were able to get our money out plus a preferred return before any of the equity holders. So the reason why fund likes convertible notes often is because it is held as debt versus a safe, which is basically just agreeing to whatever the future equity is. Of course, we won't invest in anything without a cap, but it's just it's an agreement. But again, I think safes, the reason why they're so prevalent is a function of the fact that there are so many funds like Green Egg Ventures out there, that if you're a great company, you can sort of command your own terms.
Thank you.
Doesn't mean it's easier to fundraise, for everyone.
Yes. Questions? So where are you seeing most of your deal flow coming from?
Yeah, it's a great question. Most of the companies we invest in is coming from other funds that we're close with. There are certain funds in the community that we share deals with on a weekly basis, because New York, is, I don't need to repeat over and over again, is a very much it's very much more inclusive than like the West Coast. It's very much 5 or 6 funds making up a round than one taking the entire round. So for us, what the forefront of my mind every day is what value can I provide the other funds in the ecosystem, because that's the only way that we can get value out of it, is if we're providing value ourselves. So we provide value every day. I'm sending deals to other companies, to other funds that are coming through my network, trying to help companies raise their capital, as well, just because I want to help founders, get their rounds, and founders especially that are mission driven. So we'll get companies from other funds. Of course, we get a ton of cold outreach sent to us. Probably most of the companies that get sent to us are cold outreach, but most of the ones that we invest in are ones that are introduced to us. I think that answers the question.
Alex, this is Tripp again.
Hey, Tripp.
What's the best way to get introduced to you? If you're going to do something, because everyone on the call here are trying to get introductions, obviously. What's the best way to have that happen?
I was going to ask if you wanted to post your email address in the.
I'd be happy to. First off, anyone can reach out to me. Is, I guess, importantly,
And always good to reference the breakfast so that he'll know that she was here and probably spoke to you at some point in this breakfast.
Yeah, please do that. The best way is, a lot of people reach out cold, and it's very clear that you're just reaching out to anyone and everyone, right? And I think a lot of it, to be reflective on ourselves, I think we can do a better job of going out there and saying exactly the type of companies that we invest in. Maybe would make it easier on companies that are reaching out. But the best way to reach out is if obviously you can get a warm introduction, that's helpful because we just give more attention. But we do look at every single company that comes through our that gets sent to us, to our contact email, and we look at your decks. We review it, and then we answer every company that comes our way. So reaching out is the best way to reach out, I would say, and then explaining in a very digestible way, like I discussed earlier, who you are, like what problem you're solving, why you're the right people to solve it, what your solution is, in a digestible way. So if you reach out, understand the companies that we invest in, answer those questions, I think that that could be onto something, and will increase the chances of a meeting. I do want to stress, though, that just because we're not meeting with a company doesn't mean it's a bad company. It just means that it isn't an investment fit for us. So I guess it's not about being a great company and having a great idea. It's about what makes sense for Green Egg Ventures in our strategy.
Thank you. Anybody else? I have a question. So, as we know, a lot of people have gravitated over to Clubhouse, and there are a lot of pitches going on there, and some of the rooms are crowded and some of the rooms are not. And actually, I spoke to an entrepreneur who I know and who I've worked with, and he's actually raised quite a bit of funding by going to those pitch sessions and meeting people or investors on Clubhouse. Are you utilizing that at all?
I haven't, and I think that this is a good motivation for me to start. I've just been.
Oops, you froze. Oh no. Oh, Alex, you froze. I don't know if you can hear me. I hope you can. Oh,
did I freeze? Oh, I froze.
Yes, you
Sorry.
did. You said it was a good motivation. Do you need an invitation? I'm happy to send you one.
I'm on Clubhouse,
Okay.
but I'd love to. Like I'm a very much a newbie to it. So if you have any advice or recommendations, I would love to join any of those chats or groups.
Stay out of the big rooms, and if you have investor friends who are hosting rooms, ask if you can be part of the. They have some investors who will give feedback. I think you froze again.
Sorry about that. Yeah, I'm in this. Like I said, this Michigan, in the woods connection going on over here. But I think I'm not sure how much you got there, but as I said, I don't utilize it enough, and I would love to be invited to some of your chats in the future and sort of learn the ropes.
All right, I'll find you and I'll follow you. Somebody's asking me for an invite to Clubhouse, no problem. We have time for one or two more questions if you guys have any questions, or I'll ask Alex to just provide some sage parting words of advice to entrepreneurs and people who.
Gotcha. So I think I froze again. All I heard was parting words of advice.
Oh, we have one more question from, Abby has a question, so.
I was just going to ask, because you were in New York, you've gone back to Michigan, you may come back to, go other places. In terms of geography, because in the past, before pandemic, it was so much, not only, investment thesis fit and stage fit, but also location fit. Are you seeing that has changed a lot, or how do you feel since you've moved location?
Oh, totally. I think that, the pandemic's obviously had a very devastating impact on a lot of things, but if we're looking at silver lining from that standpoint, the tools by which there's so many tools out there that make digital starting a company or meeting with companies so much easier. And now, the expectation isn't that I need to meet with companies before investing in them. From our first fund, we met with every single company except for maybe one in person before we invested. for this one, we've only met one of our companies in person before investing. So it's really normalized that. And I think, just me being from the Midwest in general, and me believing that entrepreneurship should be available to everyone, not just those near venture funds. I think it's amazing that anyone can really inexpensively go out and solve a problem that's important to them. And me as an investor, I want to be investing more in the Midwest where I'm from, and in between the coasts, and less obviously places that haven't been where entrepreneurship hasn't been accessible to a lot of people. So I love it. I love it. For me as an investor too, having a larger pool of potential companies to invest in means that I'm investing in better quality companies versus just in the New York ecosystem. Now I can look everywhere. So I think I can go on and on about it, but I love being able to do it and to invest in more people.
So I was saying that we have a few minutes left unless we have some questions from our attendees, or if you'd like to leave us with some sage words of advice.
I have a question.
Oh, okay.
Alex, you talked about how you normally get incoming deals from like either cold outreach or from other funds, but do you have other processes to spot a good startup, like a hot startup that you may miss if it's not coming into your inbox like that?
No, I mean, we definitely we'll look at other, incubators or accelerators or other places that where, good companies come from. But, it's all about, everything has an opportunity cost. If we're putting a lot of efforts into trying to identify different markers, it's so difficult at the early stage to find those markers typically, because there's just so much that isn't quantitative at that point. So, I would love to get to a point maybe in the future where I have an army of, maybe students at school, or maybe, analysts that can go out and do those things. But right now, as a fund of, 3 of us, we're investing in companies, we're doing diligence, we're assisting our current portfolio companies. We have very limited bandwidth to do those kinds of in-depth, searches. So maybe one day, but not currently.
I don't know if we have any more questions, or if you'd like to just.
Yeah. I mean, I don't have anything prepared for words of wisdom. I would just say that I think startups are very difficult, and I think that just going out and doing it and not spending people's money to do it is a very brave step that people can take, and I admire people that do it. And I think that I don't mean to sound like a broken record, but because everyone hears this, but failure is just a learning experience. So I encourage people to go explore their ideas. Don't put all of your life savings into it. Go explore your ideas. Don't live with the doubt of what might have been if you didn't do it. Try your best. If it doesn't work for 99% of the time, but sometimes it does, and great things can happen, and you might learn from it and start even a better company in a better industry. So I always encourage entrepreneurship. Just because an investor like myself isn't investing in your company doesn't mean it's a bad idea or a bad company. And I hope that people feel encouraged to go out and solve the problems in the world that are important to them without risk of feeling judged or of failing. So I admire those people. They're much braver than I am, and I encourage it.
Thank you. So we have a few minutes left. There is one new message.
I have another question for Alex. Alex, is it still true, or that, for a really early stage venture, is it easier to raise capital in the Silicon Valley versus trying to raise anywhere else?
I don't think that's necessarily true, because I mean, it's difficult for me to speak to it because I'm just, my experience isn't my experience is in New York more so. So I can't really give you a good answer, but I think that, again, maybe it goes back to what Abby was saying, but to Abby's question. But we live in a day and age where we have the digital tools to meet with anyone, network with anyone, and I think that it can often be a numbers game for a startup or a founder. So it's not New York versus Silicon Valley versus, maybe smaller ecosystems. It's how many people can I reach out to with my idea to share with, and to focus on everything. I think, I don't want to make any comments about other ecosystems because I don't know how easy or difficult it is to raise capital there.
And we don't even know how important geolocation really is anymore, or how long.
Yeah. Yeah.
So we have 2 minutes left. And I thank you for all your time and wisdom, Alex, and thank you.
Thank you.
Yeah, thanks for having me. I appreciate everyone's questions, and I appreciate everyone taking the time to